Good morning. I am Rob Gilman, co-chair of Anchin Real Estate Services Group. Welcome to our third panel, the real estate panel, the short and long-term effect of COVID on funding for New York City real estate deals. We heard from the earlier panels on the future of New York real estate and possibly how quick it may come back and what changes will need to take place in the design of the future office. Now we will discuss the financing side of New York City real estate during and after COVID. I'd like to welcome our panelists, Joseph Shanley, Investment Director of Haven Capital, Daniel Ridloff, Managing Director of Slate Property Group, Elaine Phyllis, Director of Capital Raising at Broadshore Capital Partners, and Mark Penner, Managing Partner and Founder of Emerald Creek Capital. Welcome everyone, and thank you for joining us today. So let's jump right in. Values of New York City real estate has taken a major hit during COVID. What effect is this having on funding projects? We're not in a line, so whoever, Daniel, you want to start?
Yeah, sure. So thanks again for moderating this. Kicking off that question. So I run the credit business over at Slate Property Group, where we focus primarily on the transitional and heavy lift space. And I'll just tell you, we're super bullish on construction that's going to be delivering in the future versus financings that'll be in place today. It's just super difficult for us to come up with a value today. I think we can sleep better at night comparing underwriting to pre-COVID levels for a project delivering in the future than, say, a project today delivering to a year ago. So, we're finding it super challenging to compete with existing product versus product delivering in the future just because of how we come up with a value.
Yeah, I think that's fair. I think to some extent you're still relying on track records for properties in 2019 and sort of pre-COVID performance. And I understand your point. It's a lot easier to underwrite stabilization in 3 years than to say when stabilization will occur over the next 18 months. And I think that's probably fair. I do think that there is still a bid for New York City existing assets, albeit wider than it was in 18 and 19. I think that groups will look at the construction risk or lack of track record or something of that nature and potentially shy away from future projects. But I also think that there's alternative sources of capital for those products and things are still trading and getting funded.
Yeah, I think that's right. That's what we've been seeing as well. I mean, what I think has been interesting, some of our capital has said that they're using this time to maybe do renovations and do some changes of strategy on some of their properties in New York, which is kind of an interesting way to look at it and just take advantage of the downtime. So for example, taking an extended stay hotel and turning it into micro units on the multifamily side, or doing some major renovations on a downtown office building that they wouldn't have normally done during this time period, but it's a slow period. They're not leasing anyway. So now's the time to make that investment for that 2-3 years when they're done. Hopefully the market will have recovered. So it's another approach that some people are taking towards how to invest in Manhattan right now.
Mark, anything you want to add?
Sure, Rob. Thanks for having us as well. So I'm at Emerald Creek Capital, and we are also a lender in the commercial real estate world in New York, as well as around the country, but primarily in New York. I would say that a little bit of echoing what other people have said, just assumptions have to be conservative. It's just really difficult to try and figure out value, and when in doubt, you just have to dial things back a little bit from maybe where you were. I would say in our case, a good percentage of our loans go to repeat borrowers. So I would say we always care about sponsorship and the operators that we're going to work with. But I think in times of stress and volatility, you definitely lean in to those types of relationships a little more. So for us, I think people who we have an established relationship with and people have proven an ability to execute, we're going to fund. But with that said, we have been quite active. Crisis creates opportunities, and I think some have unearthed themselves, and we started to see some pretty strong lease up data in the housing market in Q4 and December, and we like those trends. So hopefully there is a light at the end of the tunnel here. Seems like a lot of people are starting to get vaccinated, and if the numbers continue the way they have in the last couple of weeks, we do anticipate that supply will probably outpace demand for COVID vaccination, as we go into Q2. And so, as we think about the year, odds are that the second half of the year, this should be more in the rearview mirror than it has been certainly for the past year. And, markets are forward thinking, we're trying to be forward thinking. And so we're active, we're looking for deals, but we're certainly being conservative in the assumptions.
Okay, great. Which sectors are you seeing most affected when it comes to raising capital? Commercial, retail, multifamily, hotel sector?
Yeah, hospitality is, well, it's funny because certainly one of the most challenged, retail as well, but at the same time, hospitality, we're seeing a lot of capital being raised in terms of distress, right? So a lot of people who weren't hospitality players at all are now saying this is the time to jump in. I would say on the equity side, buying assets, we're seeing anything from 10 to 30% discount potentially in hotels. On the debt side as well, you're starting to see some of the notes trading. So it's interesting that areas where you think, okay, no one's going to want to play, sometimes become more popular just because there's that potential of distress. I think retail is a little harder. You really have to have a unique play. I think Manhattan was over retailed 2 years ago, so it's getting worse now. I think that's a little bit of a tougher play.
Yeah, I agree with that. I think that a bid for retail had faded long before COVID, and that's always going to be a difficult asset class in the city and potentially nationally to generate liquidity. Totally agree on the hospitality front. I think that there is a real lack of liquidity, both in terms of debt and equity capital markets there. It's a space, obviously we play in the ground lease space. That's a space where we're looking to provide liquidity in a lot of not necessarily distressed cases, but certainly in the absence of an alternative lender, we make a lot of sense there. Multifamily liquidity and debt bid seems to be fairly strong. And that's a function of the fact that stabilized multifamily assets nationally always sort of have a bid from the agencies. And so there's going to continue to be liquidity. And there's a lot of institutional investment into those products in terms of equity. In office, it really just depends. In New York, it's hard. Who wants to be the lender that puts $1 billion into a new asset in the face of not knowing when there's a return to real normalcy and what that normalcy looks like, whether it's a hub and spoke model or if it's what office looked like in 2019.
Okay. Mark or Daniel, you want to add something to that?
Sure. Yeah, I mean, just speaking from our platform, we were not very bullish on the commercial sector. As Elaine mentioned before, it was struggling pre-COVID. So, throw into the mix the COVID concept. We're hearing of the hospitality getting a boost simply by converting them to homeless shelters and opportunities like that to save some of those assets. But, we were super bearish on retail before. I'd say any modest level of retail makes it hard for us to get our arms around. It's just a matter of what tenants are still even left to lease the space. So, we're bullish on multifamily, some condos, so the resi space, but everything else for us is pretty hard to get our arms around.
So while it's too early to know what will happen, many companies, and we just learned, this morning, Salesforce came out and said that most employees can continue to work from home once things open back up. How big a concern is this to the lenders in the capital markets?
I would say it's a pretty big concern. Particularly, we are not historically a very big office lender, so thankfully, part of our safe navigation of 2020 was being significantly underweight in office and hospitality. But yeah, I think things are changed, and it could be permanent. This is really expensive real estate to have back office and operations and a lot of administrative functions that historically have occurred on the island of Manhattan. And I think people are realizing now that doesn't actually have to be. And so I think as you look at the amount of supply of office, especially with Hudson Yards, I think it's a pretty big concern to see. I like the guys who work in the lobby of my building, but I'd say we're really good friends the last 6 months. I mean, it's me and them. Like, we're the only people in the building, and so I don't know when that changes, but that certainly is concerning.
Go ahead, Daniel. You look like you're starting.
I just think the trickle down of how that impacts the residential market is really profound. When you don't need to overpay for a small apartment that you can walk to your office in, it kind of dovetails with when people are going to start, when those occupancy numbers for Manhattan especially are going to start to go back up. It means people are going to go back to work. They're going to overpay for their apartment so they can be close to their place of work. And, that goes hand in hand with when they're allowed to eat at a restaurant or go to a bar. But as of now, there's no real logic to why you need to overpay to live in Manhattan or rent an apartment, because you have no services that you're overpaying for. So, until people need to go back to work and until there are restaurants and bars to go to meet with their friends, I can't see the people flooding back to their rental buildings and signing new leases. So it's the impact to not bringing people back to the office that floats down to the multifamily sector, and in my opinion, is pretty strong.
I totally agree. I think that what COVID and return to office has done has created a massive amount of underwriting uncertainty. And with underwriting uncertainty, your audience for a request for bids, whether it's equity or debt, just gets diminished dramatically, right? And so anytime there's a lack of competition for your debt, prices are going to widen out and proceeds are going to drop. And so I think that uncertainty is going to persist for some time. And I totally agree with what Daniel's saying as it pertains to how that trickles down to multifamily. And if you look at where there's really strong institutional investment in multifamily nationally, whether it's Sunbelt or sort of Zoom cities in terms of Salt Lake City or Denver, I think all that investment is based upon the fact that just a dramatically smaller group of people are going to have to be in offices in New York City.
Yeah, I think short term, we do think that it's a tough lending environment, but longer term, I think actually we're a little bit more bullish on city office. I think Joseph mentioned the hub and spoke model. I mean, we have been seeing some of that, where some tenants are reducing their footprint in Manhattan and saying, we're going to increase our footprint in our satellite offices in Westchester and Long Island and Stanford and some of those areas. So we do think there will be some of that, but I think what we're anticipating is there's probably more of a long-term change in terms of maybe you're going to have better air filtration systems, and that's going to be something that everyone will have going forward, or there will be some basic changes, because I think now they're saying probably coronavirus will always be around. If not in this particular mutation, there will be other mutations. So it's something we're going to be living with more or less like we live with the flu. So people will figure out a way to work around it. And we expect that people will be back. So maybe it's 6 months, maybe it's 12 months, maybe it's 18, but we actually expect New York to be pretty much where it was, and people using the space pretty similarly, relatively soon.
So do I. I do believe people will be back. The question is, how fast it happens. So moving a little bit over to on the residential side, the eviction moratorium has been extended to May 1st. Most likely will be even pushed even further. Let's talk about September. How big of effect is this having on financing a property with a large number of non-paying tenants and knowing that you can't get rid of them?
I think it results in, again, a smaller audience of lenders just because of the uncertainty, and then it results in more structure, right? And that's in the form of debt service guarantees and reserves, right? There's at some point it has to, this idea that people don't have to pay rent will burn off, and it won't be justifiable. Without really being able to tell when that is, you just have to structure around it.
Anyone else have a comment on that?
Yeah, I was going to say that's a tough one for us because we've found, at least across our portfolio, which is not, there's not a lot in Manhattan, so I will say that. But we haven't had a lot of collections loss in terms of any more than we had previously. So surprisingly, we expected a fair amount, but it hasn't really happened. And I think across the industry in general, collections have been better than everyone expected. So it'll be interesting to see if that changes and if this new round of stimulus helps kind of keep things where they are, or if people just start spending their money elsewhere.
Okay. Great. A question did come in. With hospitality virtually shut down, are there buyers and lenders interested in this asset class willing to wait out the storm?
I'll say we have no interest in waiting out the storm on hospitality right now. And that's, I say that as a lender though. I think it could be a very interesting time to buy hotels, but given our risk, we don't get any of that binary upside, but we do potentially participate in the struggles if they continue longer than people expect. It just doesn't seem to make a lot of sense for us on the debt side to get involved when we could be putting our money into multifamily, or we haven't talked about where the sort of the flow of retail has gone, which is sort of last mile distribution and warehouses where you have a lot more wind at your back. So I can't talk from the equity side of the equation, but on the debt side, it's just not very appealing to us at this moment in time.
Yeah, I think, as I mentioned earlier, there is a fair amount of capital being raised around hotels right now. We actually just are in the final phases of raising this programmatic joint venture around hotel investing. And listen, I mean, there's different ways to play the hotel game right now. There's rescue capital, there's going in and figuring out recapitalizations, there's straight out debt. I mean, prior to COVID, we were very active in construction hotel lending, but not doing that anymore. But I mean, so you probably aren't going to see that. But there are definitely people looking to play in hotels. And I mean, I think it depends what sector the hotel is. The extended stay is, we're thinking will be first to recover. Obviously, if it's got more of a convention or business aspect to it, those will probably be later stage recovery. So those are going to be tougher to try and figure out a new play right now. But the ones that have some kind of a transient or more holiday type people, tourists visiting, that kind of thing, we expect a quicker recovery on those, and we are seeing a fair amount of action. And honestly, a lot of them didn't trade because the bid-ask spread was too high. So people think that they can hold on. So I think that's what they're doing right now.
Yeah, we are willing to wait out the restabilization, but obviously our capital is 99 years, so it's a slightly different approach from our perspective. And we're looking at a lot of what you're talking about, Elaine. So were operating as an option for recapitalization for assets that are otherwise great assets in good markets, where there's simply not a bid to take out an existing maturing debt stack, and we can sort of provide what I'll call rescue capital, but the reality of it is the distress only exists as a result of lack of liquidity and not because of low quality of asset.
Daniel, anything on the hospitality?
Yeah, I mean, very similar to what Mark said. I mean, on the credit side, we're not really touching the hotel space. It's throwing a dart at the wall as to when the need for hotels will come back. What business travel looks like in the future, and that just takes up a huge section of the market, especially in New York. And there's too many other opportunities to focus on that make us a little more comfortable than that hospitality space. And the only deals we're seeing in hospitality are conversions to non-hospitality uses like homeless shelters and affordable and low income and those types of opportunities.
Okay, good. So where are you seeing loan to values these days? And I know there's a lot of different sectors, but just, in an average, if you had to give somebody just a guide as to, what they should be expecting out there now.
So we're in the heavy lift business. So, for us, it's slightly different. And, for a construction loan, we're still providing financing liquidity at, call it 70 to 75% loan to value upon completion and stabilization. And again, that's 2 to 4 years from now. So a different story than projects today. But when we look at reposition loans today or condo inventory loans today, we have scenarios that could be 60% up to 80%, depending on some sensitivities. So I still think there's a world in that 70 to 75% space where people are comfortable.
Yeah, I think that's right. We're seeing kind of the same. Multifamily, especially, you're still getting easily your 65%, and there are mezz players, a lot of mezz players right now, willing to come in and go a little higher.
I think that's fair. I think CMBS world is still making it to 65%. I think in multifamily, there are people that are willing to go deeper than that, for sure. And I think that you can press proceeds fairly far because there are a lot of debt funds and a lot of mezz funds that are out there looking for good product. And if you're operating in New York, there's not a lot moving in terms of investment sales. And so that takes a big chunk of the opportunities where you would otherwise put this product off the table. And so, you're going to have people that are willing to stretch on things that they may not have been willing to stretch on previously.
Mark, I know you're not that high on the
LTV. Yeah. Well, it all depends what you think the V is, right, Rob? I mean, that's the real question here. But yeah, we're sort of, I would say we're a little more on the conservative side. I think we price pretty competitively, but we would top out at 65, I think, on stuff that we like. But I think most of our deals are more in the 55 to 65 range.
Okay. So it seems the LTVs probably stayed the same, but the values clearly have been decreasing. In the past, a refinancing meant that there was going to be distributions to the owners and investors. Now, because of these decreased values, refinancing may not even cover the existing debt, and owners will have to put in money to cover the shortfall. What are you seeing landlords doing in this situation?
Well, so it has led to, I was going to say, I mean, that has led to some of the recapitalization situations that we've been seeing. So it's either coming in and trying to find a preferred equity stake has been one solution, or trying to find a sort of a mezz player to come in and take that, a short-term mezz. So you say, okay, we're just going to pay a bit of a vig here for 2-3 years until we get through this, and then we'll be able to pay it down and get back to where we want to be. That's kind of what we've been seeing.
I agree. I think there's a flight to alternative sources of capital, and so us as buyers of lease fees, this is not a negative thing for us in the sense that we are a way for people to drive excess proceeds, and we are a attractive alternative to either selling an asset into a down market or otherwise putting on, what is probably 12%, junior mezz behind a mortgage.
Mark, did you have a comment on that?
Yeah, I was gonna say, people, they got to pony up a little. I think this is where strong sponsors, are going to be able to weather the storm. And in the recap, there's not cash out like there may have been, but actually a little more cash in the deal. And we don't have a problem stepping into an inventory loan that maybe needs to get extended because velocity of sales were slower than everyone anticipated, and showings were less in the last 12 months. That's pretty understandable, and the story kind of makes sense to us. But if we're gonna come in and help them buy time, we have been expecting some level of fresh capital to come into the deal with us, and that certainly supports the cause that they're committed to the deal, and they're not just grasping at straws, trying to play a little musical chairs. So, people who can write checks have a big advantage in this market. The guys who are max proceeds, looking to, get senior and mezz and then sell part of their GP to cover their GP. Like those guys they're gonna have a lot of trouble because the music's gonna stop.
Okay. Daniel, anything on that?
Yeah, I mean, we see it a lot in the condo inventory refinance space, where the borrowers are would recap the entire capital stack just to plug a gap to fund for additional reserves. And we see that need constantly. And it becomes, that's the opportunity to get in that space and earn outsized returns on that small vig just for the carry to get, the entire bottom stack, of the loan. So we see it a lot in condo inventory, and sometimes we require additional capital. Sometimes we don't. Sometimes we won't look at the deal because they're not willing to, but we're seeing that request more and more, especially in the inventory space.
Okay. So in the past, you can borrow a lot of money with no recourse. Is no PGs a thing of the past? I know a lot of my clients are anxious to hear that, as they have to refinance in the next couple of months with everything going on.
We like PGs, Rob.
Well, I know you do.
we've kind of always been old school and liked it at some level. Obviously as the markets got frothier, we had to be competitive. But I think it's always going to be deal specific, but certainly on the stuff that is refining out existing lenders or just trying to bridge a gap of time because of the pain. The personal responsibility goes a long way, and I think from our perspective, because there is uncertainty in timing more than anything, and to get back to values that once were, we are generally requiring some form of recourse on our deals. It doesn't have to be a full PG per se, but we want to see that responsibility, that they're not just going to leave us out to dry. Because again, going back to what I said earlier, it's like, there's some pretty binary opportunities in the market where, if things turn, these guys are going to make a lot of money. And we're not necessarily asking for equity kickers and the upside, but we want that downside protection that a senior person should have.
Yeah, I mean, our group, we do primarily on the origination side construction loans. So non-recourse is out there, but it's just more expensive, and we tend to be non-recourse. So I mean, if you want to go full recourse, you can still get a 4% loan. It's just, you're just going to pay more for non-recourse. So right now, typical bad boys and we can guarantee, but I think what we're seeing more and more, which we hadn't seen in the past, are carry guarantees. So guaranteeing operating costs and interest. And I think it's just seen as a little bit of a way to force the borrower to the table to get to the point where they're not covering debt service. It kind of forces them to come to the table and negotiate a little quicker. So that's the major change that we're seeing in terms of how recourse is working.
Okay. Joe or Daniel, anything on PGs?
Yeah, I mean, we typically are a non-recourse lender as it relates to principal. I'd say how that has shifted the last 6 months or so is that there's an outsized commercial component to the deal. Will require a partial principal guarantee that burns off as they lease up the space, kind of puts their borrower's money where the mouth is in terms of how confident they are with the retail or commercial. But as Elaine says, I mean, you're just paying up for non-recourse, and how much more are you willing to pay to not sign on the line that is dotted is the borrower's, decision to make. But, they want to sign full recourse. It's apples and oranges to non-recourse in terms of proceeds and rate.
Yeah, I agree. I think, listen, ultimately it's a function of, in certain assets and certain transactions, there's just a lower supply for debt, and in that instance, you have the ability to require things that previously you wouldn't have been able to get. And so, any time that there's a lack of supply in the debt market, structure is going to become more onerous, and this is part of that.
Okay. With the traditional banks, what are you seeing with them, their willingness to do deals in New York City? Are they staying away? Are they getting involved?
I think it's a matter of the right sponsor and the right transaction. My subset of experience here relates primarily to my former employer, SL Green, and if you look at, they've been able to do a very large construction loan with their traditional New York City lenders and a large syndicate of them. And they've also transacted on a sale on the West Side. And in that instance, there was a lender for the deal. It was a good, high credit quality in terms of tenant. But JP Morgan printed a very large CMBS deal there. So I think it's just a matter of sponsor and quality of asset.
I would say that I have been surprised at the quantity of deals that we have been paid off on by conventional sources in the last 11 months since COVID. So we have been actively getting paid off on our portfolio pretty much at pre-COVID levels and expectations. So I take that as a data point that that the banks are lending, and the other thing I'll add is we do have multiple lines of credit with regional and community banks here locally, and I speak to them on a pretty consistent basis, and all of them for the most part have expressed reasonably good health to their balance sheets and have been proactively offering us money for credit. We haven't really been using much credit just because we're pretty conservative. But when I take those two things together, I think back to 2008, and because real estate was so at the core of the financial crisis, I think all of these regulations and reforms that were put in have made banks still be pretty healthy. I mean, look, obviously there's some concerns in the sectors that we talked about, but overall, the guys who are lending on multifamily, I think they're pretty active from what I've seen.
Okay. Anybody else seeing anything with the banks?
Yeah, I mean, we take leverage on a lot of our loans from the regional banks, and I will tell you that the last 2 months or so, the handful of players in that space has grown dramatically. So they're either loosening up their wallets or different criteria entering into 2021, but looking for internal leverage on a deal right now versus back in October, November is a world of difference. So it's a positive sign.
Okay, great. So let's go from the banks to foreign money. Do you still think we'll see a lot of foreign money coming into New York City?
Yeah, I mean, we work with a lot of external capital, and the reality is it's been interesting these 12 months. I mean, there are definitely a lot of your foreign capital is still going to say we want the 5 to 8 gateway cities and that's it. But you know, at the same time, all of a sudden I'll have, you know, maybe a Korean investor who says, so what is Charlotte? You know, what's North Carolina? I'm like, okay, yeah, you're starting to think about outside of just the 5 major cities. So absolutely, foreign capital is starting to look to more of secondary markets. Not that they're truly secondary, what we would consider major markets, but top 20 markets, top 25. But you know, Minneapolis, never heard of Minneapolis before. So I mean, they definitely are looking outside, but at the same time, if you say, oh, this is a New York City deal that's meaningful to everybody, they do believe it's going to come back, and there will be no shortage of capital. This past year, yeah, tougher, but in the long run, foreign capital still is very driven by the coastal markets and by the major cities that they know and understand, and just have that recognition value back home, which is where they need to get buy-in and sell down their deals.
I mean, do I think that foreign capital will ever go back to $20 billion in 2015? Probably not. And really, because to Elaine's point, institutional money is flowing into cities that had previously, cities in submarkets that had previously probably hadn't spent a lot of time on. And so with that, foreign money will generally follow where its sort of smartest and largest partners are going.
I would add, you know, we about 40% of our firm capital is offshore based. So we talk to people in lots of different markets in Europe, Middle East, and Latin America. Overall, I would say it's a good gauge to feel, because they are a couple steps removed, and so in a lot of ways they're thinking about things much longer term than maybe we are, right, being here in the center of the storm and having felt COVID and just felt the intensity of it on a day-to-day basis. But if you look at those markets and the problems they're having and the long-term structural issues that they just have in their economies, there is still a very strong appetite to invest in U.S. real estate. And as we talk to these investors, they definitely gravitate towards those gateway markets. But we know a large European institution that did a deal in Raleigh-Durham that we were talking to them about, in Texas, and sort of other sort of not just the New York, LA, DC, Miami markets, so San Francisco. So I think foreign capital, you know, you got to have a place to put your money, and I guess, you know, Bitcoin and Doge coins probably are going to give you a little more upside, but I think when people are thinking about the safety of their capital and they're thinking about, you know, sovereign, you know, bond rates and still in negatives in a lot of the world, and close to the zero pretty much universally, you know, real estate's a nice hedge to inflation. It's not giving you the volatility of public equity markets. And so in our general conversations, there is a pretty strong appetite for putting money to work.
Daniel, did you have something?
Yeah, I mean, for some of our investors, they're as bullish as they've ever been, just to, you know, thinking there's an opportunity to get involved in. You know, the flip side, which is a minority, we have some investors that won't invest if they can't see the property. And with travel bans that are going on right now, they're just waiting on the sideline because they won't invest without being able to look, see, feel. But that will hopefully be short-term in nature. And once that gets lifted, should open up, to more retail foreign investors.
Yeah, the other thing that we're seeing is on the lending side, that hedging costs between the currencies, especially with some of the Asian countries, has gone down substantially, like 130, 150 basis points from last year. So I think on the lending side, definitely there's a lot of interest, and that's definitely good news for markets as well. So, but it's just a lot easier for them to lend now without the hedging costs.
Yeah, I mean, that's a good thing about New York City. Everybody outside the U.S. knows New York City. I actually was on a call a couple of weeks ago with a client and his foreign investor, and they were buying something in Charlotte. And the guy asked, he goes, what is Charlotte? Is that even in the U.S.? But so, as most of you mentioned, foreign money still is coming to New York City. Are you hearing of any lenders or investors that have just said, you know what, I'm done with New York City? Oh, well, that's a good sign.
No.
No, that's great. That's good to hear. So let's see. Let's talk about foreign money. So just a question came in. It was something similar to what I did have. What concessions are lenders giving to borrowers that are having cash flow issues today?
I mean, I sort of wonder if those concessions are coming to a close. I think that for some period of time between March and the end of the year, you were seeing a lot of lenders just sail out, kind of form forbearance agreements. There's only so long they can go on.
Yeah, I think that's right. We saw the same thing in terms of hospitality assets. Almost universally, I would say, there was forbearance through the end of the year. And then kind of in December, it was time to really sit down and start having those conversations where it was like, okay, now what are you going to do? What's your plan? What's your workout plan here? Or what are you going to do to get back on track? You need to go raise more equity. What do you need to do? Because forbear forever. But, I think that was the major thing, sort of like, yep, we'll let you go till the end of the year. And now it's time to figure something out. Otherwise, we have to start acting on our remedies. So.
Okay. Anyone else have a comment on that?
I do think the other thing that we were seeing is potentially allowing borrowers to use their interest reserves for debt service, which normally you would not be using it for other things. So, but giving them a little bit more breathing room to try and keep paying their debt service and not default. So I think that's coming to an end as well.
Right. With all the, these government programs, the PPP loans, obviously they're allowing, we spoke about before, the eviction moratorium. It seems that the landlords have been the ones that have been asked to almost pay for this pandemic. They're not getting the benefits, still having to pay all their real estate taxes. How big of concern, when you're speaking to whether it's the equity markets or other, types of lending, when they're seeing that landlords are really, taking the brunt of it and struggling with cash flow?
It's a risk of putting money in New York, right? I mean, previously the risk was in New York, multifamily, and, would you be able to turn stabilized assets to fair market? Or would your fair market building potentially become somehow rent controlled? And now, that threat goes deeper in terms of, are you somehow, are you not allowed to evict commercial tenants? Do you have to freeze commercial rents? I mean, that is a risk of doing business in New York and a lot of other coastal cities.
Yeah, I mean, taxes in New York are going one direction and one direction very fast. Again, from an underwriting purpose as a lender, where you have to peg some of these real estate tax numbers really crushes a deal. And with New York City specifically getting more progressive by the year, like that's not turning back. That's going one way, and that's a fixed cost. And not much you can do about that. And it directly hurts your value, because at this point, it's not related to, you know, what you're renting for or what you're selling for. It's just, cities losing money, and they need to find places where they can plug those holes.
And one of the underwriting approaches that we've always taken in New York City is that it doesn't really matter what happens to your cash flow. Real estate taxes generally don't go down.
Always go up. Okay. So, you know, there's, you know, back in really, I guess, 2007, 2008, when we had the, you know, the last correction, there was a lot of money on the sidelines that were really waiting for the prices to drop, you know, significant 20%, 30%, 40%, and that never happened. So now we've seen the significant drops in values. Is there a lot of money waiting to be deployed? And what are they waiting for? Are they expecting values still to go down, or, you know, what point are they starting to put that money back in, you know, New York City?
Yeah, there is a lot of money right now in funds and a variety of different places waiting to come in. But I think even though the values have dropped, we haven't seen a lot of sellers willing to sell into what the current value is. And so that, I think that's why we haven't seen a lot of trades. Even on, we have a group that buys loans, so secondary loans. And not a whole lot traded last year. A lot of people went out and did price discovery and said, okay, I have a loan for X, but really didn't want to sell for less than 2-3% below par. So a lot of that stuff just didn't trade. And I think we're seeing the same thing on the equity side. It's not that values haven't gone down, it's that sellers are not willing to sell right now. Plenty of money on the sidelines, still waiting.
Yeah, I think for New York City specifically, on the multifamily side specifically, it's so seasonal that clearly the leasing season for 2020 got demolished. I think people are waiting around to see what the 2021 leasing season looks like, and they'll have a much better grasp on the health of their property to understand whether it's a hand back the key situation to the bank or it's a move forward, plow ahead with fresh capital. But we're hearing and seeing a lot of that wait and see for this leasing season to see if we're going to continue to carry this property with cash every month to cover debt service.
Right. Joe or Mark, any comments on that?
Go ahead, Mark.
Yeah. So in the past years, you know, there were several funds that with distressed debt, they were buying up the debt to take over the property, knowing that the borrower would default. The old loan to own process. Are you seeing that model now?
I'm not personally seeing it, though. I don't doubt for a second that it's going on. This is you know, a really interesting opportunity for a lot of people across New York, and opportunity funds to gain control of a lot of what would otherwise be attractive assets.
Yeah, again, I think what we've seen is that a lot of those loans have just not come up. Banks have not been pushed by the regulators as they were in the last cycle to clean out their balance sheets, at least not yet. So they've been willing to continue holding loans. And I think it's just been interesting. We expected to see a lot more distress come on the market, and it just hasn't. So I don't know if that's because of stimulus, might be because balance sheets are just not being cleaned up. There's loan here or there, but you're not seeing the FDIC large portfolios that were, you know, billion-dollar portfolios that were coming out the last cycle around. So, and sometimes it just takes a while to work through the system. So it can be not the first 12 months, it can be more of a 18 months, 12 to 24 is when a lot of that comes through the system. So we might start seeing a lot more of that loan to own and just buying out those distressed. But so far, there has not been a whole lot of it.
I would say that, you know, 2017, 2016 to 2019 was a pretty golden period for private debt, private credit, private equity, to raise capital. So I think there's a tremendous amount of money in lockup vehicles that is yet to be deployed in distress opportunities. And I can say from our experience that we get calls on a regular basis from more loan to own type of firms and shops inquiring about our debt if we are looking to sell things that are at maturity or approaching maturity. So I think there's a lot of pent up demand in that space. I think to the point, there hasn't been forced selling. There hasn't been, you know, a cost action. I think we started to see it for just a flash in March of last year where things blew out, but it corrected so quickly. I think it was maybe a 1 week window where capital, you know, became incredibly more valuable. But then the flood of supply of money came back and things normalized. But yeah, I think it's there. I think there'll be plenty of guys looking to loan to own in the next couple of years.
Dana, did you have something?
No, I mean, we've seen sporadic deals come across our desk, but those are much more lender looking for liquidity, looking to sell their position for 98 cents on the dollar, not really the influx yet of all these sideline capital looking to take advantage of pools of loans. So we haven't seen it yet. Well, I haven't seen it yet.
Okay. So we have about 10 minutes. A couple of questions came in. Has COVID caused anyone to lend in different asset classes?
Well, it caused us to stop lending in hospitality. So.
It did the opposite. It caused us to narrow our asset classes.
What about in the malls or strip malls? More just complete retail, a lot of restaurants. Has that slowed down a little bit?
Honestly, it's the one asset class we won't touch. We'll do basically anything but malls.
But that was always, that's not just new because of COVID.
That is certainly enhanced by COVID. I happen to be sitting in a mall right now. I'm at a co-working site in New Jersey, and mall's empty. You know, and it's open for business, but it is empty.
I'll get to another question. Do any of the lenders look into alternative types of lending? For example, lending against subscription receivables into a fund instead of on the actual asset itself?
We do not. We only lend on the real estate.
Yeah, that's true.
Okay. Just so I think we've all agreed, and everyone today had said that New York City real estate will come back at some point, hopefully sooner than later. What do you feel is the time horizon?
Well, I'm not going to prognosticate, but I saw a couple articles in Globe Street recently, and kind of interesting. They do seem to feel like we've hit the bottom. I don't know how quickly that means we come back, but some of the stats that they threw out there were, like, for example, leasing in offices. Leasing activity was up 18% in January. Now, Midtown is still, 47% down from where they were last year, and kind of an all-time high for vacancy, but it seems to have bottomed out and at least starting to turn the corner. Same thing in multifamily. Your major markets, your New York's, your San Francisco's, have been losing 2.5% to 4% in rents a month, and now for the first time in January, starting to flatten out and maybe even rise a tiny bit. So it feels like the free fall has stopped, and we're starting to at least flatten. And in counter to that, the Midwestern markets and some of these markets that have really been benefiting from all the flight from the major cities have started to flatten in terms of you have Boise going up, 9% a year in rent, and that's sort of flattened out as well. So it does seem like maybe things are starting to get back to where we would think where cities will start to increase and some of these tertiary markets will start to flatten more. So that doesn't tell you when it turns, but it tells you the turn is starting.
Okay.
Yeah, we saw some recent data by Douglas Elliman that showed the New York City boroughs in terms of, I think it was home prices compared to or velocity or volume of number of sales compared to Long Island, New Jersey, Westchester, and Fairfield County. And, the charts were pretty interesting in that all those suburbs were peak April, May, June, July, starting to go down. And then, of course, the city area was what it was and is now kind of the hockey stick going backwards. So certainly from a home buyer perspective, the tide seems to be turning. I'm still a believer that the workforce needs to go back to work for the market to come back in all regards. And I have absolutely no idea when that's going to happen.
Yeah, I agree. I think that the workforce has to go back to work. I think that's the right answer. And everything else, normalcy in every other sector will follow that. Though there was some question in my mind as to whether or not everybody that was here will be here again, or they'll have to be filled in by new participants. I think that there's a quality of life issue in New York right now, and I'm curious to see how it's resolved when the masses return.
Mark?
Timing, I'm probably not a good predictor of that in any way, shape, or form. But, I would say it feels like residential, as people are suggesting, is going to have a driver on office. And I don't know. I don't think it gets better till next year.
Till 2022.
2022.
Okay. So, a couple of questions. So, what advice would you give someone looking to get into their first deal in terms of, capitalizing it? Don't do it. I mean,
So what is the question, just in general, how to capitalize?
No. This question was, what advice would you give someone looking to get into their first deal? I assume it related to, raising money or looking to finance a deal.
I would capitalize it based on today's NOI. Fooling yourself that you're going to go back to 98% occupancy tomorrow is wishful thinking, and you'll be in trouble tomorrow. So, my immediate advice would be underwrite as is numbers, not what you think and hope it could and dream that it could be.
I agree. I agree for the most part. Today's NOI on some of these deals that we're looking at nationally would ultimately kill the deal. So you have to give some credit, but you can't give credit for going back to December of 19. You have to figure out what the middle ground is there, and then I'd almost certainly do it with a ground lease.
Rates are still remarkably low for certain things, and LIBOR is still very low. So I would suggest short-term financing. You can take advantage of hopefully your property NOI going up in the next 2 years and refining into something better.
And we have another question. We have a couple more minutes. In terms of risk, what do you look at as the biggest, most volatile factor in a given deal right now? What are you most subjecting to sensitivity in new development?
In new development, I think it's on the multifamily front, really on all fronts, I think it's just absorption.
Yeah, I think it's sort of trying to look forward and figure out where your rents are going to be 2-3 years from now when your development is finished, and figuring out, right, if the absorption is going to be there and if it'll be at those rates.
Oh, so we have one more question. In terms of underwriting NOI, do you feel that NOI has stabilized at this point, and are you comfortable with the existing trailing 12 months NOI? Two-part. Are you giving more weight to trailing 3 months, and do you feel that the uncertainty that we saw 9 months ago is now more certain?
Short, quick answer is, New York historically hasn't been a Q4 rental market. So trailing 3 is, as Joseph said, is going to kill every deal if you looked at Q4 rents in New York City. So, it's tough. I think we really need to wait and see how the leasing season does to get a comfort on what the new stabilized NOI looks like. But to look at just the last 3 months in any time, pre-COVID, post-COVID, to look at, November, December, January for leasing in New York City, you would get crushed.
Yeah, I agree. I don't know how you look at any version of that NOI now and say, I'm comfortable. Every projection about NOI is very subjective and a little intuitive, and there aren't a ton of numbers to back up what NOI should be in 2022.
Yeah, I don't think you would want to look at the last 12 months and say, use this as my stabilized NOI. I can't imagine anyone would want to do that right now.
Yep.
Mark, anything?
No, I think, look, as Daniel said a little earlier, though, you got to look at where the numbers are today. I mean, I don't want to think about pro forma. It is what it is. And, if you're thinking about that first deal, if you can make the math work based on this entry price and this income, then I think you probably have a pretty good shot at making money because, things should tick up, but we're not going to underwrite the uptick.
Right. Just before we end, just see any final comments or thoughts, Daniel?
I think we covered it all. We're in a tight spot now. It seems like the light at the end of the tunnel that is a little closer than it seemed a couple months ago. Fundamentals are starting to come back, but we've got a long way to go, and there are still players in the space to finance the projects.
Elaine?
Yeah, I would say the same. Keep the faith. We've seen New York go through a lot. Every time we bounce back, and we will do that again this time. And in the meantime, there's a lot of different sources of capital on the sidelines, which will find a way to keep feeding the beast.
Joe?
Yeah, I totally agree. I think it's a super interesting market right now. There's a lot of opportunity. The next 18 months will be a fascinating time to be in New York City real estate.
Yeah. Mark, final thought?
Just know your space, know your stuff. Don't try and go into something that you're unfamiliar with, but take what the market gives you. You probably are going to get some opportunities, and thanks, Rob, to you guys and the whole team for hosting this, because this is a great forum, and I appreciate being part of it.
Thank you. And thank you, Daniel, Elaine, Joseph, and Mark. Thank you so much for this great discussion.